In my last video, we talked about a stress-free investing method, dollar cost averaging. If you haven't checked it out, I'll link the video in the description box. Dollar cost averaging is most suitable for equity index fund for the reasons being: one, dollar cost averaging works the best with more volatile assets, and dollar cost averaging can help you invest at an average price of assets over a period of time. And investing in an index fund, which is normally broadly diversified, makes sure that you are not sinking your money into a bad investment. Today, let's talk a bit about index funds, and I'll walk you through step by step on how to start investing in an index fund in Australia using Vanguard as an example. If this sounds good to you, please give this video a like and keep watching. If you're going down the path of financial independence through passive investments, you may have heard of index fund a lot, but what is an index fund really? Firstly, it's a type of mutual funds, and mutual funds are investment pools that investors input their money into with the hope of earning a profit, and the fund managers works on behalf of all investors to achieve this goal. So by purchasing one share of mutual funds, you will have a small fraction of every single asset included in this fund. Compared to the majority of the mutual funds, which are actively managed by the fund managers, an index fund tracks a particular market index. What's a market index? A market index is a hypothetical portfolio of investment holdings that represents a segment of the financial market. Take the stock market index, for example. If you want to assess how a stock market performed last week, you can look at the performance of every single stock in the market, but it's more practical to use only one single measure that represents the performance of the entire stock market. If you're in the US, you can check S&P 500 index, which includes the top 500 US companies. If you're in France, you can check CAC 40. If you're in the UK, you can check the FTSE 100, etc., etc. I think there's misunderstanding about what a market index is. Although the stock market index is the most common index, but there are indices that measure other assets as well, such as the government bond index, or the commodity index, or the rates for the real estate sector, or even index that tracks the performance of hedge funds. Index funds follows a passive investing strategy because it seeks to mimic the benchmark index. For instance, if you're buying the Australia's S&P ASX 200 index funds, you're buying the top Australian 200 companies in one share. And index funds are normally broadly diversified and highly transparent with low management fee because the fund managers doesn't have to be actively research and analyze every single stock to build the portfolio. If you're only looking at index funds, you may start with the broad stock market index funds that managed by the global asset management firms like BlackRock or Vanguard, and then later on you can think of some sector index funds that managed by the local boutique asset management companies. Both Vanguard and BlackRock are US firms, and they offer products to Australian investors as well. Before we jump into the step-by-step setup on how to invest in an index fund, let's take a moment to look at a typical fund name. By cracking the code of the fund name, it will save your research time and land on the investment you're looking for sooner. Let's look at the fund under BlackRock's management. I've got iShares Global Listed Property Index Fund. A fund name typically includes fund provider. In this case, it's iShares under BlackRock management. And the sub-asset class, which shows where the fund's assets are concentrated. This is normally a geographic region. In this case, it's global listed. Then is the main asset. It's either equity or bonds, or commodity. If it doesn't indicate on asset class, more likely you're looking at an equity fund. In this case, is the property. Then it goes to the giveaway. In this case, the fund name tells us it's an index fund, but not all index funds have the index or tracker into their names. Some fund names have share class like class A, B, C, or D. In our case here, it's actually class D Australian dollar hedged, which we can't tell from the name. So index funds are awesome, right? But how do you actually purchase them? Let's jump onto the computer and then set up a personal investor account with Vanguard. All right, so we are at the Vanguard Australia website, and then you click into personal investors and then click join Vanguard today. and then click open an account. Normally it's individual that we click into it and confirm, agree and consent, and then you just follow the process until that is all set up. So once you have set up your Vanguard account, then you can log in, put your username and your password, hit next, and then a security code will be sent to your provided mobile number. On the page that you will see your portfolio value, hit cash. If you haven't set up your cash account, you can link your bank account to deposit any cash into the cash account to Vanguard. It normally will take 2 or 3 working days. You can buy any Vanguard managed mutual fund here that it will specify the type is managed or ETF, and then you can buy most of the ASX shares, but you are not able to buy any ETF from other fund providers or international shares. So far, they don't have any mobile app. I can't invest or check my portfolio on the go, but most of Vanguard products are not designed for short-term tradings, and you can't transfer any existing ETFs to their platform. So this is how you set up your Vanguard account and some points on how I think of it as an investor's point of view. One thing that's really confusing to me when I started to choose a platform to purchase the index fund is that should I go directly with the fund provider like Vanguard or go with any other broker? Or if I sign up directly with Vanguard, should I go with the managed index fund or buy the Vanguard ETFs? If you have similar questions, please feel free to grab any information that I'm going to talk about in this video, and hopefully you'll find it helpful. But before we start to compare the 3 options, let's briefly talk about ETFs. ETF stands for Exchange Traded Fund. It is very similar to mutual funds in many ways, except the major difference is that it divides the ownership into shares held by shareholders who buy and sell the shares with other investors on the stock exchange throughout the day, traded just like a stock. Although most of the ETFs' underlying assets are index funds, but there are active ETFs that are actively managed by the fund managers who put their own portfolios into the fund in Australia too. Managed index funds and index ETFs share a lot of similarities, such as they both passively track a particular index, and they both have low fees and they provide diversification. Here I'll talk about the major differences to help us choose a better option that we were facing. Well, the trading mechanisms are different. For managed index funds, investors will buy and sell the funds directly through the fund provider. While for index ETFs, investors will sell and buy the shares with other investors as if they are buying or selling a shares of a stock. The trading price is different as well. For the managed index fund, all investors will be settled at a net price, which is the net asset value at the end of the day. But for the index ETFs, because investors can trade the shares as the stock, so they can even short the shares or even buy the shares with margin. So the market price of the ETFs is determined by supply and demand as well, and it varies throughout the day. The fee structure is different as well. For the managed index fund, they will charge you a management fee on top of a yearly account fee, as well as a tiny buy and sell spread cost. But for the index ETF, you will be charged a management fee and a brokerage fee per trade. But if you go directly with the fund provider, they normally will waive this brokerage fee. In terms of liquidity, managed index fund investors wanting to redeem their fund will only know the exit price until the next trading day, and the actual receipt of the fund will take several days as well. On the other hand, an index ETF with large fund size is more liquid. Investors can check the live price and sell immediately if they wish, but just to note that an ETF with small volume can be really difficult to get out of the investment. And the minimum investment requirement is different. Normally for the managed index fund is higher. They will normally require you $5,000 to start with, but you can invest as little as $500 into an index ETF. Investors' ability to track the ETF's price throughout the market hours and the ability to use advanced orders and positions could be drawbacks of ETFs because it makes some investors to use ETFs as short-term arbitration tool, which will be going against the intention of investing in the index funds after all. And remember, every time you trade, you'll be charged a brokerage fee from $10 to $30 per trade in Australia, unless you go directly with the fund provider. Back to the points, I have three options when it comes to buy a Vanguard product. The first option, I could go with Vanguard directly with a Vanguard Managed Index fund. Second, I could buy a Vanguard ETF through Vanguard. And third is I could buy a ETF through another broker. Where should I go? The biggest factor to make the right decision is probably the cost because eventually it can really erode our investment returns. The fee structure among the three options are different, and it also depends on how frequently we invest. So let's just make an example of a Vanguard product and see the fee structures. So let's say we are going to invest in Vanguard Australian Shares Index ETF. So the first option is I will invest a Vanguard Australian Shares Index Fund, which is managed VAN 0002AU. The management fee will be 0.16% per annum, and the account fee that I will be charged is 0.2% per annum, capped at $600. And also I will be charged with the buy and sell spread cost, which is 0.05% of the amount of my transaction. And the minimum investment amount requirement is $5,000. The option 2 is I will invest the VAS, that's the ticker, through Vanguard. The management fee I'll be charged is 0.1% per annum, and I also will be charged with the account fee, which is 0.2% per annum, capped at $600. And the minimum investment amount is $500. The option 3 is I will buy the VAS ETFs through a NAP trade. The management fee I will be charged is 0.27%, and then I will be charged a brokerage fee for $14.95 per trade, up to $5,000 per trade. And the minimum investment requirement is $500. By looking at the fee structures of the three options alone, we can see from the third option that we buy the ETF through NAP trade. Unless I invest $5,000 every time to make the brokerage fee to take up the smallest percentage of my transaction as possible, it's not really a good option if I want to adopt a dollar cost averaging with small frequent amount investing. To compare investing in managed index fund and index ETFs through Vanguard, definitely the index ETF seems more attractive with lower fees. But remember, the market price of the ETFs that you buy and sell could be inflated or deflated depending on the demand and supply at the time you trade it. And also it requires a little bit of your attention to track the prices unless you trade as the market price. In this perspective, it seems the managed index fund works the best with dollar cost averaging method because you don't have to worry about the price you end up trading. As you know, you'll be settled as the NAV, which is the net asset value at the end of the day. If you can put your emotions aside and control yourself to check the prices of the ETF throughout the day and not to use the ETFs as a short-term day trading tool, go ahead to trade the ETFs with the fund provider directly. Just out of curiosity, let's quickly calculate if an investor decides to invest $2,000 monthly using dollar cost averaging into this fund and what are the fees end up to the three options. For the option 1 that invests in the managed index fund through Vanguard, the yearly fee will end up $98.40. So it will take up about 0.41% of the principal that you invested. Option 2, which you invest a Vanguard ETF through Vanguard, the fee will end up to $72, which takes up 0.3% of the principal. Option 3 is to buy Vanguard ETF through NAB, which the yearly fee will be end up $244.20, which takes up about 1% of the principal. We can see the differences of the cost is quite large. I was a bit lost when I started to select a platform to invest my first index fund, because there are so much bits and pieces of information, but nobody could provide me a bigger picture. So I really do hope that you could use of the information provided in this video, but please do your own research, because the management fee of different index funds are different and my choice might not suit your situation. Well, I hope you enjoy watching the video. If you have made this far, please give this video a like and subscribe my channel. I'll see you next week. Bye.